Everybody has heard about quantitative easing, but now the Federal Reserve might start doing gold QE. So how will this affect the price? What on earth is it? How does it work? I'm going to reveal the answers to these questions in 3 simple, fast steps. Step number 1, let's go over, well, first and foremost, the prettiest looking chart I have probably ever seen. That would be the gold price. Right now, we'll say today's date, going all the way back to October 2024. So about a 12-month chart. And I mean, you got to think it's headed straight for 4,000. Will it get there? I don't know. There are no certainties. There are only probabilities. But when you look at this chart, you have to assume that there's a very high probability that we go from, let's say, 3,863 roughly, where we are at the filming of this video, and continue to go higher and higher and higher. Now, nothing goes in a straight line. But again, I think if you look at this chart, if you look at the fundamental drivers, there's a very high probability we see gold trading at 4,000 in the very near future. And I would like to remind everyone, so many times on these videos, I hear people in the comments, or I see people in the comments saying, oh, well, George, sure. If you would have done X and not invested in the S&P 500, then you would have missed out on all these gains. Okay, well, let's look at the price of gold year to date is up 45%. Now, for all the S&P bros out there, remind me, what's the S&P 500 up? Oh yeah, that would be 13%. So I'm not a rocket scientist, but I do know that 45% is better than 13. Okay, back to the whiteboard video. So let's assume for a moment the central planners at the Federal Reserve and the Treasury, they're looking at the exact same chart and they're saying, yeah, it's probably going to get up to $4,000 and it's up 45% this year. Whoa, wait a minute here. Wait a minute. I think the U.S. government, the Treasury, owns gold. In fact, they own 8,100 tons of gold. So you might ask the question, on the government's balance sheet, how much value are they attaching to this 8,100 tons of gold? $11 billion. Now again, I'm no math genius, but I know that at today's prices, let's just say 4,000, if you have 8,100 tons, it's worth way more than 11 billion. In fact, it's worth roughly 990 billion. So we've got almost a $1 trillion discrepancy between what the government is valuing their own gold versus the actual market price at this rate, let alone if the price goes up to 4,000 or even beyond. So you guys know how central planners think. They see this massive spread and they think to themselves, how could we cash in on all that dough? How could we use the 900 billion or trillion dollars that we're not recognizing on the balance sheet? How could we monetize this? And it would basically become free money that we could spend out into the economy, and we could buy votes, we could buy weapons and send them to Ukraine for all of our defense buddies, or we could just kind of somehow sneak these out to these government contractors where they could go ahead and give us, let's just say a commission, and then I could go ahead and buy that $1 million McMansion. This is how the politicians are thinking. They're looking at this as a huge opportunity to put money in their back pocket or the back pocket of all their buddies. The only problem, of course, is right now, even if they do make the adjustment on the balance sheet, they still need a way to monetize all the gold. Insert the Federal Reserve and gold QE. Step number 2. So how would this actually work? To answer that question, let's go straight over to a recent article from Zero Hedge. The title here, Gold Revaluation Imminent. U.S. Treasury hoard tops $1 trillion for the first time.
So they say on the back of the 45% surge in the price of gold this year, U.S. Treasury hoard of the barbarous relic, has surpassed 1 trillion in value for the very first time. This is what we were talking about back in step number 1. And then they get down to the balance sheet, and this is what I was referring to earlier as well, where you can see this 11.1 circled. That's the 11.1 billion that they, the central planners, are valuing the gold that they have on their balance sheet right now. So here's where it gets really interesting. Let's read right from the Zero Hedge article. Unlike most countries, the U.S. gold is held by the government directly rather than the central bank. The Fed instead holds gold certificates corresponding to the value of the Treasury's holding and credits the government with dollars in return. That means an update of the reserve's value in line with today's prices would unleash roughly $990 billion into the Treasury's coffers. Let's just round up and call it an even 1 trillion. They go on to say, while some people might dismiss this and call it a crazy conspiracy theory, that other countries have been doing this very, very recently, not third world countries. As Bloomberg reports, Germany, Italy, and South Africa all have taken the decision to revalue their reserves in recent decades. And here's the crazy part. On net, the revaluing of this gold would increase the size of both the Treasury and the Fed's balance sheet, allow for the TGA, the Treasury General Account, to be used for Treasury priorities. That's just code for politicians putting your money in their back pocket and lining the pockets of all their cronies while at the same time buying votes. Getting back to the article. Meanwhile, the Fed and Treasury magically conjure up some $990 billion out of thin air to be spent on whatever. Like I was just saying, all because the Treasury agrees the fair value of gold is, and to be fair, the fair value of gold. So then you have to ask, well, what would the knock-on effects be? I mean, what would happen to the price of gold? What would happen to inflation in the United States? Would prices just skyrocket like they did in 2021 and into 2022? Those are the questions we're going to answer right now.
Step number 3. So now let's go over these knock-on effects. And oh, by the way, at the end of this video, I'm going to reveal a bombshell that is going to totally blow your mind. But before we get there, let's get into the Fed and your drunk, insolvent Uncle Sam. In fact, I forgot to put his initials on his hat. We always do that. Your drunk, insolvent Uncle Sam. There he is. And we all know that he likes to spend money like a drunken sailor. So right now, as we said earlier, the Fed on their balance sheet, they've got 11 billion of assets. Those are the gold certificates. And let's assume for a moment they've got 100% of the gold certificates that represent the actual gold the Treasury has. Let's assume they've got 100% of that on their balance sheet. I don't know if they do, but I'm just going to assume they do for the sake of this example so you guys understand the concept. Okay, so they've got 11 billion in assets, gold certificates, and they have 11 billion in liabilities, and this would be the balance of your drunk, insolvent Uncle Sam. Remember, we call that the TGA, the Treasury General Account. Now, and I want to be super, super clear, these numbers are not exact. There's a lot more than 11 billion in the TGA right now, and sometimes it can get below. Again, we're just using these numbers for the sake of the example. Okay, so we go over to the balance sheet of your drunk, insolvent Uncle Sam. He's got the 11 billion as an asset. That's the liability. That's his cash balance, if you will, in his account at the Federal Reserve, the TGA. So what we're talking about here is just someone over at the Fed just going over to the computer and well, I've got to do this really quick before my lunch break. I'm just going to go over here and we'll just delete that one. We're going to delete that one. And then we're just going to go ahead and that's going to be deleted as well. Someone over at the Treasury can do that prior to their lunch break. And what we're going to do is we're just going to add a T. Woo. See how that works? Tricky. So you just took your account balance from 11 billion up to $1 trillion. Woohoo! The government just made almost $1 trillion. Boy, they really had to work hard for that one, didn't they? So now this guy right here can spend even more money, all these green money signs, into the real economy. And we've got the average Joes, and we'll just say business XYZ. He can take all of his new currency units, all of his new spending power, and go ahead and buy those votes, put it in his back pocket, or put it in the back pocket of his cronies. So what's interesting about this is it's a lot different than normal government spending. Why do I say that? Because in normal times, you would have your drunk, insolvent Uncle Sam. He would have to go hat in hand to the real economy and say, please, please, please give me your money, in the term of selling debt, treasuries. Or he would just put a gun to your head and say, give me your money or you're going to jail. That would be taxes. So the key point there is usually when he's spending money into the economy, it's money he's taken out of the economy. So it's not as inflationary, all else being equal. But this is just brand new money that literally didn't exist before. He's not taking it out of the economy first in the form of issuing debt, treasuries, or taxes. So my base case is this would likely lead to inflation, or at least inflation prices going up higher than they otherwise would have. But there's some nuance there. What is your drunk, insolvent Uncle Sam spending the $990 billion, or we'll call it an even trillion? What is he spending it on? See, if he takes that $1 trillion and just sends it over to Zelensky in Ukraine, probably not going to do anything to inflation because there's no additional currency units chasing goods and services right here in the United States. But if he takes all of this cash and he spends it on UBI or stimmy checks, well, then there is a lot more currency units chasing goods and services, and those currency units are owned by individuals who have a high propensity to spend. So not only are you increasing, we'll just call it the money supply, but then you're increasing the velocity as well. So the next question would be, what would this do to the actual price of gold? And my answer is probably not that much. You say, well, George, if it's going to lead to potentially higher prices, then gold's an inflation hedge. Kind of. Over long periods of time, I'm talking decades, it is absolutely a way to maintain your purchasing power. But that doesn't necessarily mean that if you look at a chart of the CPI, it's going to correspond directly to the price of gold. Often there's an inverse correlation, believe it or not. Gold really isn't a short-term inflation hedge. It's more so a short-term and mid-term hedge against counterparty risk, which is why I think the gold price has gone up so much this year, because you have all these central banks around the world buying gold. Gold that wasn't on their balance sheet before. It's not just revaluing. And then more recently, you're starting to see a lot of capital go in to these gold ETFs. So that represents investors out there maybe speculating on the price of gold. But here is the key. You see, I've got a lot of buddies that are in the gold business, and they actually own gold dealers. And they're telling me that the retail investor, the average Joe and Jane out there, they are still net sellers of gold, believe it or not, to the point where the spreads on buying physical gold is very, very low. So if you had the retail investor that was freaking out, that had all of this FOMO, similar to what we saw in 2011, when gold was really peaking during its, you might even call it a bubble, but when it was peaking during its last bull cycle, you saw all of the retail investors just going out to every single gold shop they possibly could and buying any coin, any gold bar, and therefore those dealers were charging a high premium. So again, the fact that the premium is very, very low tells you that retail isn't participating in this move up. But at some point in time, my guess is they will start participating, and that would take the gold price even higher. So my point here is, would this in and of itself take the gold price higher? Not really. But when you consider all these other factors, I think the probabilities would suggest that over the next 6 months, over the next year, the gold price will likely, again, no certainties, only probabilities, would likely be higher than it is today. All right, now let's go over this bombshell that I was talking about earlier. Hopefully you guys are sitting down. Go ahead and pull up that glass because it is definitely stiff drink time. Now let's do a little trick. Let's assume for a moment this is not the Fed. In fact, I'll just do this. That'll make it even easier. And let's just assume this is JP Morgan. And let's assume that JP Morgan, or any bank out there, Wells Fargo, Goldman Sachs, let's assume for a moment that they buy gold from the Treasury. Or let's just say they buy treasuries. Or let's just say they go out to the average Joe and Jane and buy stocks. What happens to their balance sheet? Well, their balance sheet increases by the amount of the stuff they just bought. You see, here's what happens. Let's just assume for a moment this isn't a trillion. And let's also assume for a moment this guy is not your drunk, insolvent Uncle Sam. But let's just assume that it's the average Joe that has an account with JP Morgan. So I'll just do this quickly here. There we go. I always do this. So there's the average Joe, and he's got an account with JP Morgan. And right now, there is $1 in Joe's account. Therefore, that's his asset, but that's JP Morgan's liability. And JP Morgan probably has an offsetting asset in terms of maybe bank reserves or a loan or something like that. But then JP Morgan looks over at their customer Joe and says, well, wait a minute, buddy. You've got more than just $1 as an asset on your balance sheet. You've got a lot of gold. Let's just say that Joe has $1 million worth of gold. So JP Morgan says, Joe, I would love to buy that gold from you. And Joe says, okay, we'll go ahead and do that because, again, retail net sellers. So then what JP Morgan would do is they would go ahead and they would add that gold to their balance sheet. So now on their balance sheet, they just add an M. Well, it'd be $1 million, $1, but you guys get it. And then the liability side of the balance sheet, because they have to create that money that, by the way, didn't exist before, to pay Joe. And then Joe has the $1 million in cash in his account at JP Morgan. But notice what has happened. We have literally increased the money supply by $1 million. Therefore, there's more currency units in the real economy chasing goods and services. Literally the exact same thing that happened when the Fed did QE. What we have to realize, and this is the bombshell, is when banks buy assets from non-bank entities, whether it's the average Joe, the average Jane, or the Treasury, it's effectively quantitative easing. So while most people are hyper-focused on exactly what the Fed's doing every single second, you as prudent investors should focus on the Fed, but you should also, even more so, focus on what the banks are doing. Because at the end of the day, the commercial banks are actually more important than the central banks.
Hey guys, I wanted to take a quick break from the video to share with you a new investment strategy I've been using. Most of you know the cornerstone for my portfolio is physical gold. The problem is you always have a negative carry because you have storage fees. Same thing with silver. But I've actually found a way that you can be paid to own physical gold and silver. And here's the best part. You're not just paid an interest rate in fiat currency. You're paid an interest rate in more precious metals. Now, I know a lot of you are saying, oh, George, this sounds too good to be true. And it's exactly what I thought when I first heard about this. Here's the backstory. I get a lot of businesses that come to me and say, George, we want to sponsor your videos. Usually I turn them down because it's not really a good fit. But I had a company come to me the other day called Monetary Metals. And when they were walking me through what they do in their business model, I thought to myself, this is a complete no-brainer. In fact, it sounded so good, I set up an account myself, and it's been going extremely well. So I said, sure, sponsor a couple videos, because this is a service that I think would be hugely beneficial to my audience. So here's how it works. You can go ahead and set up an account with them and fund it with your existing precious metals, or you can buy directly from them, usually a little less than 1% over spot. And right now, as we speak on the platform, there's opportunities to be paid about 4% interest. So again, this is not in fiat currency. They're paying you in additional precious metals. So if you deposit, let's say 100 ounces of gold with them, at the end of the year, you'll have 104 ounces of gold. So to join the thousands of investors, including yours truly, who are being paid to own physical gold and silver, you can go to monetary-metals.com/gammon. That's monetary-metals.com/gammon.